can it be used? And so, and I'll be starting out with some market presuppositions that I assume that everybody can agree on to a certain degree. What is cumulative delta? What does it show us? What are its applications? I'll just be touching a little bit on divergence, but I'll be mainly sticking to the horizontal price levels that I trade, and then some examples of that divergence, and then some real life examples with real money. That's always a good thing compared to some of those other OTA students or teachers that don't. So market presuppositions. Markets are, there's buyers and sellers, and it's a double auction process. It's not a single auction where somebody's asking for sellers or buyers for, I don't know, like a piece of jewelry. There's constant buyers and sellers for the same price or the same asset. And to touch on everybody's kind of grounded understanding of how the market works, there's areas of supply and there's areas of demand, both indicating where strong selling or buying may or will occur depending on whatever probability set that you're working with, however strong your strategy is. And the market's objective is to discover fair prices where liquidity is usually highest and where buyers and sellers agree on a certain price. In this process of price discovery or value discovery will fall out of balance into new or pre-existing areas of value. And this active price discovery is where the majority of day traders make money. And some of those examples are price level rejection, bounces, breakouts, momentum trades, etc. And of course, not every single trade setup has 100% statistical probability. And this is kind of something that we can all understand. This is just a Euro USD Forex pair on a 4-hour time frame showing these basing extended range candles, indicating areas of supply and demand. So what is cumulative delta? Cumulative delta, or delta or CD, as it will be mentioned later, is a method to visualize live market order participation. Like Daniel mentioned, we're looking at who's pressing which button, who's crossing a spread, who's paying that premium. Where market orders are considered aggressive action because buyers and sellers need to pay that premium. CD shows the delta or difference in the amount of market orders on the bid and ask per candle. And a simpler way that I like to kind of think about it is who's winning per candle, who's really the strongest participant. Is it really strong in selling, or is it really strong in buying? And that's probably a really simple way of explaining it, but I'm a simple person. What does it show us? Like I mentioned, it shows us the aggressive participation in the market. Limit orders are usually considered very passive, and market orders are considered very aggressive. And it's here where we see how the market is responding to this market order participation. So what are its applications? The primary ones are the classical divergence, hidden divergence, and the horizontal price levels. And more advanced analysis like Futures Trader 71 uses, which is filtering it by the amount of volume traded, basically seeing who are the participants. Is it the overall delta? Is it larger participants like banks having, instead of, selling one contract, selling 100 contracts or even more? And the CD is primarily used as an odds enhancer. I would, for my trading strategy or system, I would not use it by its own. But that's just me. I like to have volume profile, and with a combination of CD for entering trades, just makes my heart beat a little bit less. All right, and let's see. And it shows us who's in control, like I mentioned before. This is just a very simple explanation. I don't trade divergence too much, but I do keep an eye on it. And I know that Kathy will be going to a great example showing this, since I consider my divergence expertise on the elementary stage. So here are just some simple examples. So this is with an oscillator. And right here, we can see that CD works in a very similar fashion. You can see A, B, and C failing to make new highs on this on the ES. And then you can see how the sellers are still in control of price. And then we can see that after that C level in that wave formation, we're selling down, and also we're seeing lots of market sell participation pushing all the way down at this sticking point in D, where we then bounce back up. And here's another example, not the greatest example, but I found it on the internet, of course. We can see this divergence also in play right here. We can see on this A formation, he also uses volume, but we're just going to be looking at price right here. We can see that it fails to make new lows, while buyers on the market side are still pushing price up. So very strong buying, even though we are in considerable kind of sideways action. What does it do? Once it diverges properly at that failure to make new lows, it goes back up into this next formation where we see another divergence, continues to move up higher, and then we can see that as we're moving up higher in this D formation with volume declining, we eventually move down for a bit. All right, now into the fun stuff. So how am I using this? So I start out with a chart showing delta just as Daniel has, starting at 0 per session, per Globex session, starting at around 1800 EDT, and I'm looking at where price is sticking throughout the session. So when I open up my chart at an hour before open or 2 hours before open, I'm looking at where those sticking points are. And I chart them out, as you will see in the examples I have. I just chart them out in a very simple line. I want to see where price is going up, stopping, going back down, breaks through, and then coming back to that level, just like you would do with a regular horizontal lines on price. These levels represent where the areas of balance. I would argue that where these balance are is in market orders, and trades are usually taken on a strong breakout on my side where it closes outside of the horizontal price level, indicating that we're going to have a continuation of whatever move we have. And then the opposite, trades are taken with strong rejections of new prices. So when price goes up to a certain level, and it fails to make up a new, it fails to close outside of it. And then exits, like Daniel mentioned in great depth, is when price goes, delta goes down, and then it reverses very strongly. And that would be an indication that you would be exiting a trade. All right, so right here, this is not a trade example, but this is showing the YM, the Dow, 600 tick chart. And this is explaining or illustrating where those horizontal lines are placed. So I have these horizontal lines. I don't know if I can actually zoom in. No, I can't. So I have these horizontal lines. I'll be sharing this this slideshow, so it makes it a little bit easier for everybody. So I have these. You can see how price came up. This is looks like around 1 a.m. So price was coming up and it was failing to close. Came back up. It's still a sticking point. Still had a bit of basing on the delta side, and then it broke out. So I lined that area back up. But what I'm looking at is how these levels are sticking. You can see that these levels are actually significant on the delta side. So when these levels are created, they come back down and they respect it to a certain degree. All right, so it's going to be kind of a short lecture, but I want to be just showing the real life examples primarily. So this is the first example that I have. This is, again, with these horizontal levels I placed. And there's a bunch of lines going on. It looks a little bit crazy, but you can see that right here, I have this overnight bearish trend line. That doesn't really come into play too much, but I have what's called the IB low and the IB high. It's going to be this line right here that I'm looking at primarily. So this is the IB high, and this is the overnight high. You can see right here that the volume profile that I placed on it showed that volume failed to close above the overnight high, showing me that there was a weak high during the regular trading session. So that showed me that there's a potential for it moving down. So I was looking for a short on this particular day. This was, I can't see which day this was on, but you can see that it was a failure to close above it on the price level. And also it looks like it did close above it, but it promptly came down at this horizontal level. And this is at this point I was looking to see what shorting opportunities I could take. So it came back down to the IB high, and the IB high is created, the initial balance high, during the first hour of trading during the regular trading session. So for Eastern Standard Time, that's from 9:30 to 10:30. And these are basically the highest and the lowest price created or made during that 1 hour trading session, or the first hour of trading during the regular trading session. So there was this volume profile that I put right here. It closed below that, but I wasn't looking there. This is when I entered my trade right here. So I can see that if you come down, this is the first candle that I looked at on Delta. So I can see that it closed strongly below that. You can consider that maybe a bearish engulfing candle. Not really engulfing on the technical side, but it is substantially larger. So it broke through that. That was my first indication that there was a lot of weakness, and this was a potential reversal area where sellers are going to come back into play. So I entered short right there, expecting that the price was going to be continuing to sell beyond the IB high, and so it did. And where I took my profit was right at this level. This was at the end of this distribution right here, at the distal side of this distribution. And that was for, that was a single contract on that. All right, this next example, this is just another illustration I have showing how price sticks to these levels that you place. So again, drawing out these horizontal levels starting at 1800 EDT, and you can see that these levels are respected to a certain degree. I mean, you can consider these zones, but I just like to draw lines just for simplicity's sake. And you can see that this area right here where price was basing and then started a strong move down where sellers really came into play, it had the same or similar reaction later on during the regular trading session. So that's just something to keep in mind, how these horizontal lines do have a significance. All right, here's another example. This was from a couple days ago. So this is a 600 tick chart, and this is showing the volume profile setup that I had. Right here, I have I had an entry when I saw that the cumulative delta was breaking through. It closed above this horizontal line, and I like to hit market buy because I like the excitement in my life. So I hit market buy across the spread, and my risk was right below this candle, and this was for approximately 1.5 or 1.75 to 1 trade risk to reward. So another great example of that. This trade later on did hit that level that I was looking at, but I was seeing that this was a weakening of delta. And the next example right here is a great example. This horizontal line, you can't see it all the way for the Globex session, but this was another sticking point that I had. And what did price do when it closed above? I went ahead and entered, and this was part of my scalping method right here, where there's a continuation. You place basically from the lower low to the next higher low or the higher high, and then you kind of mark that same trend line. You drop from that drop right there, and then you bring it back up. And here, this was an area where I entered based again off that breakout, and then you can see how price or delta continued to move strongly and just roll that out until I got to a nice area. And right here, this was more of a busy day on my end. I was trying to find out what price was doing, keeping my losses very tight. But you can see that right here, these sticking points again come into play. So this was looks like the lowest that delta made during the overnight session. So you can see that then when price closed below that, then this was a nice indication. This actually continued to go lower, but my entry initially was on the breakdown, and I held that through. I had also a trend line created there. It was a little bit of a messy day. I believe that was during rollover. So yeah, that's just, I want to get some quick examples. I didn't want to take too much of people's time. Any questions?